Ind AS 103 Business Combination. What do you mean by business combination? Business combination is a transaction in which acquirer obtains control of another business by acquiring its net assets or acquiring its significant equity interest. That means here acquirer obtains control of acquiree by acquiring its net assets or equity interest. So, in order to be called a transaction as business combination, there are two elements. As per Ind AS 103, there are two elements. First element, acquirer obtains control of the acquiree. Control definition is defined in Ind AS 110 and acquiree is a business. So, there are two elements which are required to be fulfilled to call a transaction as a business combination. What is a control? Control as per Ind AS 110. Control exists if and only if all the following conditions are satisfied. First condition, power over the investee. Second condition, exposure or rights to variable returns from its involvement with the investee. Third condition, ability to use its power over the investee to affect the amount of the investor's return. If all the three conditions are satisfied, then it will be said that control exists. First one, power. Second, variable returns. Third, ability to use that power. Next, what is a business? One of the element to call a transaction as business combination is business. Acquiree is a business. So we'll consider what is business. A business consists of inputs and processes applied to those inputs that have the ability to contribute to the creation of outputs. So to call a business, there should be input, process, output. Although businesses usually have outputs, outputs are not required for an integrated set of activities and assets to qualify as a business. The term business is defined as an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing goods or services to customers, generating investment income such as dividend or interest, or generating other income from ordinary activities. That means business means some set of activities and some assets are there for generating investment income or generating other income from ordinary activities. In such a case, it will be called as a business. What are the elements of business? Under the first element, input. Any economic resource that creates outputs or has the ability to contribute to the creation of outputs when one or more processes are applied to. Example, tangible assets, intangible assets is called as input. Second element of a business is process. Any system, standard, protocol, convention or rule that when applied to an input or inputs creates output or has the ability to contribute to the creation of outputs is a process. Example, strategic management process, operational process and resource management process. Third element of business is output. The results of inputs and processes applied to those inputs that provide goods or services to customers, generate investment income such as dividends or interest, or generate other income from ordinary activities is output. So there are three elements of a business: input, process, output. Next, concentration test. An optional test, that is the concentration test, has been introduced to permit a simplified assessment of whether an acquired set of activities and assets are not a business. That means to determine whether it is a business or not, we use concentration test. If test is met, it is not a business, no further assessment is needed. If test is not met, further assessment to be made to determine whether it is a business or not. The concentration test is met if substantially all of the fair value of the gross assets acquired is concentrated in a single identifiable asset or group of similar identifiable assets. In such a case, it will be considered as asset acquisition, not a business acquisition. In concentration test, there are three steps. Step number 1, measure the fair value of gross assets acquired. How to calculate fair value of gross assets acquired? Fair value of consideration transferred, including fair value of non-controlling interest and fair value of previously held interest. Add fair value of liabilities assumed, excluding deferred tax liabilities, less cash and cash equivalents and deferred tax assets. We will get fair value of gross assets acquired. Step number 2, identify the single identifiable assets or group of Similar identifiable assets. Step number 3. Determine if substantially all of the value determined in step number 1 is concentrated in the value determined in step number 2. If yes, then it is considered as asset acquisition. Otherwise, needs to assess business definition as per Ind AS 103. That means if substantially all of the value determined in point number 1, step number 1, is concentrated in value determined in step number 2, it is considered as asset acquisition. Otherwise, we need to consider it as a business and further assessment need to be made to determine whether it is actual business or not. Example on concentration test. Entity A holds 20% interest in entity B. Subsequently, entity A further acquires 50% share in entity B by paying 300 crores. The fair value of the assets acquired and liabilities assumed are as follows. Building 1000 crores, cash and cash equivalents 200 crores, financial liability 800 crores, deferred tax liability 150 crores, fair value of entity B is 400 crores, and fair value of non-controlling interest is 120 crores. That is 30% of 400 crores, 120 crores. Fair value of entity A is previously held interest is 80 crores. That is 400 crores into 20%. Entity A needs to determine whether acquisition is an asset acquisition as per concentration test. In concentration test, there are 3 steps. Step number 1, calculate fair value of gross assets acquired. Under that, first one, fair value of consideration transferred. It includes fair value of non-controlling interest and fair value of previously held interest. That equals to payment made by entity A to entity B, 300 crores, plus fair value of non-controlling interest, 120 crores, plus fair value of entity A's previously held interest, 80 crores. That is 500 crores. And fair value of liabilities assumed, excluding deferred tax, that is 800 crores. Cash and cash equivalents, 200 crores. Therefore, total fair value of gross assets acquired is 1100 crores. In the above case, substantially all fair value of gross assets acquired is concentrated in a single identifiable asset, that is a building. What is the value of building? Value of building is 1000 crores. Hence, it should be considered as asset acquisition. That is, here it is 91% of the value of gross assets. How 91%? 1000 crores divided by 1100 crores. Here, 91% of the value of gross assets is concentrated into single identifiable asset, that is building. So it is considered as asset acquisition. A judgment is required to conclude on the word substantially, as substantially is not defined in the standard. In our view, we have considered 91% of the value of as substantial to conclude the above transaction as asset acquisition. Next, asset acquisition. Acquisition of assets or group of assets that does not constitute a business is an asset acquisition. All the assets acquired as a part of asset acquisition would be recognized and measured based on allocation of overall consideration paid in the ratio of their relative fair values. No goodwill or gain on bargain purchase will be recognized in case of asset acquisition, and deferred tax asset or deferred tax liability would not be calculated on initial recognition of asset acquisition. Any transaction cost incurred on asset acquisition will be capitalized with the value of asset. That means it will be added to value of asset. Accounting for business combination, acquisition method or purchase method. There are 6 steps involved in business combination accounting as per acquisition method or purchase method. Step number 1, identifying the acquirer. Step number 2, determining the date of acquisition. Step number 3, calculation of purchase consideration transferred. Step number 4, recognize and measure identifiable assets and liabilities. Step number 5, recognize and measure non-controlling interest. Step number 6, recognize and measure goodwill or gain on bargain purchase. Under that, first step, identifying the acquirer. Acquirer is the entity who obtains control over the acquiring. It is usually the entity that issues consideration. Exception is, in case of a reverse acquisition, the acquirer will be different. Step number 2, determining the date of acquisition. It is the date on which acquirer obtains control of the acquiring. It is the date on which acquirer legally transfers the consideration, acquires the asset, and assumes the liabilities of the acquiree, that is the closing date. However, the acquirer might obtain control on a date that is either earlier or later than the closing date. For example, the acquisition date precedes the closing date if a written agreement provides that the acquirer obtains control of the acquiree on a date before the closing date. An acquirer shall consider all facts and circumstances in identifying the acquisition date. For example, if any government approval is required for acquisition, then date of acquisition will be date on which government approval is obtained. Next, step 3, calculation of purchase consideration transferred. How to calculate purchase consideration? Fair value of cash or assets transferred as on date of acquisition plus fair value of shares or debentures transferred as on date of acquisition plus present value of deferred consideration as on date of acquisition plus fair value of contingent consideration as on date of acquisition plus pre-combination period SBP awards, share-based payments awards. That gives total purchase consideration. Deferred consideration. What do you mean by deferred consideration? Deferred consideration is a consideration that is payable in future without any condition. It will be valued at its present value in calculation of purchase consideration. At every year end, unwinding of discounting is required to be done. The journal entry for unwinding of discount is finance cost account debit to deferred consideration account. Next, contingent consideration. What do you mean by contingent consideration? Contingent consideration is the amount paid by acquirer only on occurrence of certain future events. In calculation of purchase consideration, recognize the contingent consideration as on date of acquisition's fair value. Fair value of contingent consideration as on date of acquisition will be already given in the question. Contingent consideration may be either settled in cash or shares. In case of changes in fair value of contingent consideration at each year end, if it is to be settled in cash or variable number of equity shares, that is variable number of shares not fixed as on date of acquisition, it meets the definition of financial liability and it will be remeasured at fair value at each reporting date. Changes in fair value will be recognized in P&L. Next, changes in fair value of contingent consideration at each year end. If it is to be settled in fixed number of equity shares, it meets the definition of equity. Hence, it is not remeasured at fair value at each reporting date. Next, contingent payment to employee shareholders. If contingent consideration is paid for being in employment, it will not be form part of a purchase consideration. It will be treated as remuneration expense. In case of other contingent consideration in the capacity of shareholders, it will form part of purchase consideration. Share-based payment award, SBP award. Under that, replacement awards. An acquiree may replace its SBP awards, that is replacement awards, for awards held by employees of the acquiree. Replacement awards are of two types: pre-combination period awards, post-combination period awards. Pre-combination period awards will form part of purchase consideration. What is the amount that will form part of purchase consideration? Amount that will form part of purchase consideration in case of pre-combination period is fair value of original award into expiry period divided by original vesting period or revised vesting period, whichever is higher. In case of post-combination period awards, they will not form part of purchase consideration. It will be allocated as a service cost over the remaining vesting period. What is the value? Value equals to fair value of replaced awards minus value allocated to pre-combination period. Next, non-replacement award. Non-replacement awards are outstanding SBP awards of the acquiree that the acquirer does not exchange for its own SBP awards. That means non-replacement awards will not form part of purchase consideration. Non-replacement awards are of two types: vested awards, non-vested awards. In case of vested awards, the value credited to SBP reserve is classified as non-controlling interest. In case of non-vested awards, if it is pertaining to pre-combination period, it will form part of non-controlling interest. How to compute it? Fair value of original award into expired period divided by original vesting period or revised vesting period, whichever is higher. Next, in case of post combination period, it will be recorded as employee cost over remaining vesting period and the credit forms part of non-controlling interest, NCI. Next, direct cost of acquisition. Examples of direct cost of acquisitions are stamp duty fees, due diligence fees, legal fees, investment banker fees. Direct cost of acquisition, if it relates to asset acquisition, it will be capitalized in the cost of asset acquired. In case of direct cost of acquisition relates to business combination, it will not be included in purchase consideration. It should be charged to P&L account as an expense. Step number 4. Recognize and measure identifiable assets and liabilities. Acquirer shall recognize all identifiable assets and liabilities acquired and measure them at fair value as on date of acquisition. Recognition. When the acquirer applies the recognition principle under business combination, it may record certain assets and liabilities which the acquiree had not recorded earlier in their financial statements. Example, research and development cost of acquiree. If such research and development cost meets the definition of intangible assets, then recognize them as intangible assets as per Ind AS 38. Assembled workforce. It is not an intangible asset because control and future economic benefits are not certain as employee can leave the organization. Classification of assets and liabilities acquired on the basis of conditions existing as on date of acquisition. So assets and liabilities will be classified based on the conditions existing as on date of acquisition. Exception to the classification. In case of lease, the classification as operating lease or financial lease, which was done at inception of the lease, cannot be changed as on date of acquisition. So in case of lease classification, once classified as on date of inception, it will follow. It cannot be changed. Exception to the recognition or measurement principle. Exception may result in two scenarios. An asset or liability which otherwise would not have been recorded gets recorded, or assets and liabilities are measured at a value other than the acquisition date's fair value. Next, contingent liability. Ind AS 37 do not apply in determining which contingent liabilities to recognize as on date of acquisition. Instead, the acquirer shall recognize on date of acquisition a contingent liability assumed in a business combination if it is a present obligation that arises from past events and its fair value can be measured reliably, even if it is not probable that an outflow of the resources will be required to settle the obligation. Outcome as per Ind AS 37 and business combination. In case of possible obligation will not be recognized as per Ind AS 37, and in business combination also it will not be recognized. In case of present obligation means not probable that outflow of economic benefits will occur. It will not be recognized as per Ind AS 37, and it will be recognized if reliably measured as per Ind AS 103, that is business combination. Next, present obligation, it is probable that outflow of economic benefits will occur and cannot be measured reliably. It will not be recognized as per Ind AS 37, and it will not be recognized as per Ind AS 103 also, as per business combination. Next, income taxes. The acquirer should recognize and measure a deferred tax asset or deferred tax liability arising from the assets acquired and liabilities assumed in a business combination in accordance with Ind AS 12 income taxes. Employee benefits. The acquirer records the fair value of the obligations for any post-retirement obligation as per the principles of Ind AS 19. Non-current assets held for sale. The acquirer shall measure an acquired non-current asset that is classified as held for sale at the date of acquisition at fair value less cost to sell as per Ind AS 105. Indemnification asset. The acquirer in a business combination may indemnify, that means compensate for harm or loss. The acquirer, here acquirer will compensate the acquirer against losses above a specified amount on a liability arising from a particular contingency. As a result, the acquirer obtains an indemnification asset. The acquirer shall recognize an indemnification asset at the same time that it recognizes the indemnified liability measured on the same basis as an indemnified liability. If contingent liability acquired and disclosed by acquirer, then indemnification asset on such contingent liability will also be disclosed. Amount of indemnification asset cannot exceed the amount of liability. Next, share-based payment award or transaction. The acquirer shall measure all the share-based payment transaction, whether replaced or non-replaced, as per Ind AS 102. Next, reacquired rights. As a part of business combination, an acquirer may reacquire a right that it had previously granted to the acquiree to use one or more of the acquirer's recognized or unrecognized assets. Examples of such rights include a right to use the acquirer's trade name under a franchise agreement, or a right to use the acquirer's technology under a technology licensing agreement. A reacquired right is an identifiable intangible asset that the acquirer recognizes separately from goodwill. Operating lease. In case acquirer is a lessee, the acquirer shall recognize right of use assets and lease liabilities for leases identified in accordance with Ind AS 116. The acquirer shall measure the lease liability at the present value of remaining lease payments as if the acquired lease were a new lease as on the date of acquisition. The acquirer shall measure the right of use asset at the same amount as the lease liability, adjusted to reflect favorable or unfavorable terms of the lease when compared with market terms. If acquirer is a lessor, in measuring the acquisition's date fair value of an asset, the acquirer shall take into account the terms of lease. The acquirer does not recognize a separate asset or liability if the terms of an operating lease are either favorable or unfavorable when compared with market terms. Contingent liabilities. For a levy that would be within the scope of Appendix C, levies of Ind AS 37, the acquirer applies the requirement of Appendix C to determine if the obligating event that gives rise to a liability to pay the levy has occurred by the acquisition date. Contingent asset explicitly prohibits recognition of contingent assets. Contingent assets can never be recognized. Step number 5. Recognize and measure non-controlling interest on date of acquisition. Non-controlling interest represents net assets not owned by the acquirer, that is parent. Measurement of non-controlling interest. To measure non-controlling interest, there are two methods: fair value method or full goodwill method. Second, proportionate share in net assets method, that is partial goodwill method. In case of fair value method or full goodwill method, we consider fair value of shares held by non-controlling interest. In case of proportionate share in net assets method or partial goodwill method, non-controlling interest will be calculated as a percentage of identifiable net assets. Step number 6. Recognize and measure goodwill or gain on bargain purchase. How to calculate goodwill or gain on bargain purchase? Purchase consideration transferred plus non-controlling interest plus fair value of previously held equity interest in acquiree as on date of acquisition minus net assets acquired, identifiable net assets acquired, will give goodwill or gain on bargain purchase. Step acquisition. An acquirer sometimes obtains control of an acquiree in which it held an equity interest immediately before the date of acquisition. This is known as business combination achieved in stages, that is step acquisition. In a business combination achieved in stages, the acquirer shall remeasure its previously held equity interest in the acquiree at its acquisition date's fair value and recognize the resulting gain or loss, if any, in P&L or OCI as appropriate. Gain on bargain purchase. Gain on bargain purchase. Gain on bargain purchase is rare. So, in case of gain on bargain purchase, if reasons for gain on bargain purchase is clear, recognize gain on bargain purchase in OCI as on date of acquisition and then accumulate in equity as capital reserve. In case a reason for gain on bargain purchase is not clear, directly accumulate gain on bargain purchase in equity as capital reserve. The gain shall be attributed to the acquirer and there will be no allocation to the non-controlling shareholders. That means no allocation will be done for non-controlling interest holders. Next, common control transactions, which is carved out to IFRS 3. This is not given by IFRS 3. It is given by Appendix C of Ind AS 103. What is common control business combination? Common control business combination means a business combination involving entities or businesses in which all the combined entities or businesses are ultimately controlled by the same party or same parties before business combination and after business combination. What is the hint to identify common control transaction? Before and after business combination, the entity should be controlled by same shareholders. Example of common control transaction is mergers between fellow subsidiaries and acquisition of an entity from an entity within the same group. Method of accounting for common control business combination. Common control business combination should be accounted for using pooling of interest method and not acquisition method. Here, pooling of interest method is used in case of common control business combination. The pooling of interest method is considered to involve the following. First one, record all assets and liabilities of the acquiree at book value, that is carrying amounts. No adjustments are made to reflect the fair values or recognize any new assets or liabilities. Second one, the identity of the reserves should be preserved and shall appear in the financial statements of the acquirer in the same form in which they appear in the financial statements of the acquiree. Third one, purchase consideration payable to the acquiree for the business combination may consist of securities, cash, or other assets. Securities shall be recorded at nominal value. In determining the value of consideration, asset transferred other than shares shall be considered at their fair values. Difference, if any, shall be transferred to capital reserve and should be presented separately from other reserves. Positive balance and negative balance both shall go in capital reserve, and no goodwill shall be created under any circumstances. So that means in case of common control business combination, no goodwill will be recognized. Only capital reserve will be recognized, either positive capital reserve or negative capital reserve. Journal entries in the books of acquirer. In case of common control business combination, debit all assets of the acquiree at book value, credit all liabilities at book value, credit all reserves at book value. To purchase consideration payable account, PC may be payable in shares at nominal value and cash and other assets will be at fair value. The balancing figure will be capital reserve, either positive capital reserve or negative capital reserve. Next, demerger. Demerger is an arrangement whereby some part or undertaking of one company is transferred to another company, which operates completely separate from the original company. Shareholders of the original company are usually given an equivalent stake of ownership in the new company. Here, acquiring company is called as demerged company. Acquirer company is called as resultant company. Accounting for demerger. It is done in two ways. In case of demerger not under common control and demerger under common control. Hint to identify whether demerger is under common control or not under common control. If demerged company, that is acquiree, had a major shareholder who had control, and after such demerger, such shareholder was issued shares in the resultant company in the same proportion, then the major shareholders is controlling the company both before and after the company. That is, it will be the demerger under common control. That means here acquiree who has control before demerger. After demerger, resultant company shares was issued to acquiree company shareholders in same proportion. Then majority shareholders controlling before demerger and after demerger are same. In such a case, it will be considered as demerger under common control. Demerger not under common control in the books of acquiree, that is demerged company. In case of demerged company, that is acquiree, in case of demerger not under common control, derecognized assets and liabilities transferred, and difference, if any, will be transferred to capital reserve. The journal entry will be derecognition of liability account debit, derecognition of asset account credit to asset account. Balancing figure will be capital reserve. Capital reserve may be positive or negative. In the books of acquirer, that is resultant company, apply acquisition method of accounting. Next, in case of demerger under common control, in the books of acquiree, that is demerged company, derecognize all assets, liabilities, and reserves transferred, and difference, if any, will be transferred to capital reserve. Entry will be liability account debit, reserves account debit to asset account. Balancing figure will be capital reserve. Capital reserve may be positive or negative. Acquiree does not record inflow of purchase consideration, as purchase consideration is directly issued to shareholders or members of the acquiree. In case of common control, purchase consideration is not recognized, and there will be no goodwill also. In the books of acquirer, that is resulting company, apply pooling of interest method in case of demerger under common control. Next, reverse acquisition, concept of substance over legal form. The step 1 of the acquisition method or purchase method is identifying the acquirer. Acquirer is the entity which obtains control over the acquiree. Generally, the entity which issues consideration is the acquirer, but in some cases, the acquirer may be different from legal acquirer. A reverse acquisition occurs when the entity that issues securities, that is legal acquirer, is identified as the acquiree for accounting purpose. The entity whose equity interests are acquired, that is legal acquiree, must be the acquirer for accounting purpose for the transaction to be considered as reverse acquisition. That means here there are two parties, legal acquirer and accounting acquirer, and legal acquiree or accounting acquiree. In case of reverse acquisition, legal acquiree will be accounting acquirer. Example of reverse acquisition. Reverse acquisition sometimes occur when a private operating entity wants to become a public entity but does not want to register its equity shares. To accomplish that, the private entity will arrange for a public entity to acquire its equity interest in exchange for the equity interest of the public entity. In this example, the public entity is the legal acquirer because it issued its equity interest, that is equity shares, and the private entity is the legal acquiree because its equity interest was acquired. Its equity interest were acquired. It results in identifying the public entity as the acquiree for accounting purposes, that is accounting acquiree, and the private entity as the acquirer for accounting purposes, that is accounting acquirer. Steps for accounting on reverse acquisition. There are 5 steps. Step number 1, determining the accounting acquirer. Step number 2, calculation of deemed PC, deemed purchase consideration, and calculation of goodwill or gain on bargain purchase. Calculate purchase consideration as if the accounting acquirer would have acquired accounting acquiree. Also, goodwill or gain on bargain purchase will be calculated based on deemed PC, deemed purchase consideration. Step number 3, all assets, liabilities, reserves, and equity share capital of accounting acquirer will be recorded at book value. Step number 4, the net assets, only assets and liabilities of the accounting acquiree will be recorded at fair value. Step number 5, calculation of goodwill or gain on bargain purchase. Goodwill or gain on bargain purchase will be calculated based on deemed purchase consideration, deemed PC. Next, measurement period. Ind AS 103 provides a measurement period window wherein if all the required information is not available as on date of acquisition, the measurement period is lower of the following: date on which acquirer receives the information about facts and circumstances that existed as on date of acquisition, or 1 year from the date of acquisition. Whichever is lower will be the measurement period as per Ind AS 103. Any change in the provisional amounts of net assets acquired due to new information available during the measurement period which existed as on date of acquisition will be adjusted against goodwill or gain on bargain purchase. The measurement period summary. If information is obtained within measurement period and it relates to circumstances as on date of acquisition, then provisional value of asset or liability will be adjusted and corresponding effect will be given against goodwill or gain on bargain purchase. If NCI, non-controlling interest, is based on proportionate share of net assets and provisional amount of any asset or liability change, then non-controlling interest will also change. Next, information obtained within measurement period but does not relate to date of acquisition, then any change in value of asset or liability will be made through P&L account. Here, adjustment will not be there against goodwill or gain on bargain purchase. Adjustment will be made through P&L account only. If information is obtained after measurement period, any change in value of asset or liability will be made through P&L account. Here also, adjustment will not be made through goodwill or gain on bargain purchase. Adjustment will be made through P&L account only. Next, determining what is part of business combination transaction. The acquirer and acquiree may have pre-existing relationship, either contractual or non-contractual, before business combination, that is separate from the business combination. The acquirer shall identify any amount transferred to acquiree as consideration and any amount which is transferred to acquiree with purchase consideration for such separate transaction shall be deducted from purchase consideration and accounted separately. Settlement amount of pre-existing relationship that is assumed to be not part of business combination. That means that settlement amount will not form part of purchase consideration. Settlement amount of pre-existing relationship. In case of non-contractual relationship, it is assumed to be settled at fair value. In case of contractual relationship, the settlement amount will be lower of fair value less carrying amount or settlement value, whichever is lower.